Hey, Mark and Laura. Thank you for taking a little bit of time out of your day here to come and meet with me. Previously, we've gone over several of your financial goals that you're looking to accomplish. Today, I'd like to take a little bit of time looking at some other topics, just to ensure we've had a complete review and analysis of your overall portfolio. In particular, today, I'd like to look at your investing and retirement planning strategies. You brought forth to me a desire and a goal of having an asset allocation for your investments, 50% in the stock market, 50% in bonds. The sub-asset allocation of that was 10% aggressive stocks, 20% growth, 20% in the S&P 500, 35% corporate bonds, and then the remaining 15% in the 90-day Treasury bills. While overall this is a pretty well-balanced portfolio, I had several concerns about that asset allocation after getting to meet and know you. In particular, Lauren, you've informed me you're planning on working an additional 10 years. So we're going to have a steady stream of income for an additional 10 years from you, along, of course, that's helping with the health benefits there. Also, you guys have informed me that you are moderately risk investors. So I feel very comfortable recommending having 60% in the stock market, 35% in bonds, 5% in the money market. There's several reasons behind this change in asset allocation. First, you had mentioned that you wanted to have 10% in aggressive stocks, which was in the long term provides great returns, and the short term is very volatile. I would recommend decreasing that amount to 5% in aggressive stocks and move that towards the S&P 500. The S&P 500 actually has better expected rate of return and less volatility than your growth stocks. Thus, this would give you a slightly better rate of return, and at the same time we're decreasing some of the volatility. Furthermore, I caught something else. On the 90-day Treasury bills, they're expected to have the same rate of return of 4% as the money market. It does not make sense to add more risk, though it's not very much, of having the 90-day Treasury bill here, then just keeping it in a safer investment such as the money market here, getting that same rate of return. I would recommend your sub-asset allocation be 5% aggressive stocks, remain 10% in growth, 35%, 45% in the S&P 500, 35% in corporate bonds, and then the remaining 5% in the money market. After this point of implementing this asset allocation, I would recommend we set you up on a glide path here. So at intervals of every 5 years, we look to decrease the volatility of your portfolio and add more income-based investments. Particularly in the first 5 years, I would recommend we move to a 50% stocks, 40% bonds, and 10% in cash. Of course, throughout this time, we are going to maintain keeping at least a minimum of semi-annual rebalancing to ensure that we're staying within the proper asset allocation. At 10 years out, I believe this is a very important juncture. At this point, Lauren, you're planning on retiring full-time and quitting work, and we need to shift down to become even more conservative with the investments here. I'd recommend we go towards 40% in the stock market, 50% bonds, and the remaining 10% in the money market. At 15 years out, I recommend we even go more conservative at this point. Here, I'd like to do 30% in the stock market, 60% in bonds, and the remaining 10% in the money market. This, of course, is absolutely subject to change. When life events, things happen, or we need additional funds, or we know they're going to be occurring in the short term for cost, we will have to adjust as needed here. But this is a great guide as you're transitioning throughout your retirement. On the retirement side, though, there are several things that we really need to think of. Not only is it asset allocation for the investments, but it's very vital that we think of asset location. This is going to help ensure that we not only have a good portfolio, well diversified, but a very tax efficient portfolio. Currently, Mark and Lauren, you have 3 retirement accounts. Mark, you have a profit sharing plan through your business, along with a small IRA. Lauren, you have a 401k plan through your business as well. There are several advantages to these plans here. For Mark, first, I'd recommend upon retirement that you go ahead and roll over your profit sharing plan into the IRA. IRAs are typically just less flexible, or more flexible, and give you more investment options than in a retirement plan. Lauren, the same for you. As you retire in 10 years, I recommend you roll over to an IRA in your name as well. The tax advantages that you get from retirement accounts is that you do not have to pay any capital gains or any income earned throughout the year from the investments. However, you do have to pay taxes on any distributions you take out, as these are tax deferred accounts. They will get taxed at your ordinary income tax rate. As far as the non-retirement account, I recommended earlier in your portfolio to open up a revocable trust where Mark, you and Lauren are the trustees. The reason behind this is to use this to protect the proceeds from your sale of your business and ensure your wishes are going to be carried out with those proceeds. I'd also recommend, with all the extra cash that you have lying around in your checking accounts and money market, that you shift those assets inside this revocable trust. Of course, leaving enough to do your daily transactions in your checking accounts. So when it comes down to asset allocation and where we should put these, I recommend here today that you put the bond side 100% into the retirement assets to ensure you're not going to pay taxes on the annual income. This will be very, very great for tax efficiency. In particular, you should look at putting the bonds in the 401k and the IRA first, and if any extra for the percentages, put it in the profit sharing plan. From there, you want to ensure that you get as much of the stock side as you can in the profit sharing plan. However, most likely as we implement this plan, you are going to have extra flow that you are going to have to put in the revocable trust. For the section that goes in the revocable trust, it is very important when we do that with the aggressive, as much as possible, with the aggressive and growth stocks, as you will only have to pay capital gains. This plan that I've outlined will both look out for your retirement assets and ensure you have a tax-efficient portfolio to help fund yourself as you go through retirement. Mark and Laura, thank you so much. You guys are both very valued customers here. I appreciate your time and getting to work and getting to know you. If you have any questions, please reach out to me. Have a great day. Thank you.